The market is entering one of its most historical phases that we've experienced in many, many years. And so I want to today share with you 7 tactical steps that you can use to increase your defenses for your portfolio. Because until this point, you likely were able to get away by simply focusing on market risk. Is the market going to go up? Is the market going to go down? Are you in? Are you out? But things just got a little bit more tricky because, as you might have noticed, we have record high inflation. So on one hand, your dollars are devaluing. At the same time, the market is incredibly volatile. And at the same time, the banks are having bank runs where maybe even keeping cash there isn't that safe. And so taking all these moving pieces into consideration, I want to share with you these 7 steps that you can apply today to make sure that you're protected doing whatever may lie ahead. Number 1, the first risk you need to hedge, of course, is market risk. And that's probably the one risk you've been thinking most about. It's whether you're in, it's whether you're out. It's whether you're exposed to the market or whether you're sitting in cash, and what kind of different markets you're exposed to. The way to think about it is following. The truth is, neither you nor I have control of what the market will do. People will tell you that they can control what the market will do, but for most people, unless maybe your name is Elon Musk or Jerome Powell, the market will do what the market will do. So the one thing you can optimize for is what happens to your money when the market does certain things. And so the way to practically apply that to yourself is to think about, okay, when the market goes up 1%, how much do I make? When the market goes down 1%, how much do I lose? And that is essentially what we're talking about, how much exposure we have, and also what kind of portfolio volatility do we have. And those are numbers you can find online when you search, for example, hey, what is the annualized volatility? Volatility is, in any given time frame, what's the range a price moves around, right? So the annualized volatility for Bitcoin, for example, across most time periods has been like 65 to 70%. So in any given year, on average, Bitcoin might move 65, 70%. That could be up, that could be down. With the S&P 500, for example, which is the index for the American stock market, the annualized volatility is about 15 to 20%. The great thing is, in a bad year, you'd lose a lot less than with Bitcoin, but same way in a good year, you'd make significantly less. So the key thing for you to figure out is, for your personal situation, how much downside can you stomach, and work back from there. Number 2, counterparty risk. Now that's something we talk about all the time in the hedge fund world and in the professional asset management world, but it's something that rarely crosses people's minds as individual investors, because they assume that as long as something has a website and as long as something has a deposit button, it's probably run like a bank. And the truth is, most of the time it's not. And so I think 2022 was a great year to highlight the reality of counterparty risk. I mean, you can look at the crypto sector where people trusted Celsius with the money, insolvent. BlockFi, insolvent. FTX, fraud. The list goes on. Or then you just look at the banking sector this year, where you had Silvergate Bank go out of business, Silicon Valley Bank go out of business, and now there's a laundry list of other banks that are all struggling, where the question is, how solvent are these banks actually? And if they go down, will my money be safe? And so it's important for you to question, with every place you park your money, 1, what do they do with your money? And 2, if it's an investment vehicle where you hope to make a return, worse, or if they guarantee a return, you should always ask, how are those returns being achieved? And if it doesn't make sense how those returns are being achieved, if it's too good to be true, you probably want to move your money out. People never think about counterparty risk until it's too late, and counterparty risk is something that goes from 0 to 1 real quick. Number 3, leverage risk. So leverage, I talk about a lot on this channel, because ultimately I think leverage can be a very powerful tool, but at the same time, it's how so many people blow up. And when you look at leverage risk, I want you to look at leverage risk both in your investments, and again, as to part 2, the counterparty risk, how are your counterparties using leverage, right? Because, for example, you might keep your cash in a bank, and in your mind, this is my safest asset class. But in the meantime, that bank, is running crazy levered games where they might go insolvent, and now what in your mind was the safest bet is the least safe bet. So on one hand, you might want to look into, okay, the places you park your money, how they're using leverage, and then for yourself, look, let me just put it to your heart. We're going through one of history's most uncertain financial times. We've really kind of gone off the track here, where there's a lot of question marks as to what will happen. And as somebody very wise told me, a few weeks ago, he said, in a time like this, he's a high up at one of the biggest top 4 banks. He said, don't be a hero. And I think there's few examples that are as powerful as 3 Arrows Capital. Ethereum Capital was the biggest crypto hedge fund in the world. They were crushing it in 2020 and 2021, supposedly making insane returns, starting with a small capital base, growing as high as like $10 billion. Now, the ultimate downfall seemed to be something as simple as disrespecting leverage and thinking you're smarter than the market. Where ultimately what they did was, the market had already drawn down, let's say 40% or so. And what they would do is pretty much just go degenerate leverage long. They were thinking, hey, it's probably impossible for Bitcoin to go under 20K. So let's just lever up. And if things go up, oh my God, 10 billion on lever. I mean, they would have made deca billions on these trades. Except even the biggest, even the smartest, even the most influential in the industry can be wrong, and the market will humble you. And so ultimately, your best bet in uncertain times like right now, stay away from leverage. Whether that is in your portfolio, like 2x margin on stocks. I know people that had 2x margin on blue chips, like Meta, and then Meta drew down 80% and they got liquidated. Same way with crypto. Same way also with real estate. Real estate is always touted as the safest bet, the safest investment. Well, real estate never goes down until it does. Number 4, and that's something most people don't think about, which is concentration risk. There's this old saying, don't put all your eggs in one basket. And there's something ironic about it, because I find that some of the most successful people actually do put all their eggs in one basket, right? It's the one thing that made them wealthy because they're specialized. Maybe it's the business, right? Or maybe it's like one big investment they made that really grew over time and now makes up most of their net worth, right? And I'm speaking particularly to those people right now, because ultimately, I run a fund for a living, and we've got over 100 limited partners, everyone being a multi-millionaire. So I have seen behind the scenes of how have people made money, what do they do for a living, and so I see these common threads. In the early stages, right, most people have extremely high concentration. It's only after they have an exit, maybe they start a family office, that they have a properly diversified portfolio. With concentration risk, I want to look at 2 things. One is having too much concentration, because the problem is every single industry has what we call idiosyncratic risks. An isolated risk to one specific sector. Maybe you are a bank investor and you love bank stocks, right? Maybe you had all your money in bank stocks, and guess what just happened? Most regional banks plummeted 66, 70% plus, right? Credit Suisse, all the bondholders got wiped out, right? And so whether you had a concentration in that space, or I know people that made a good amount of money in pre-IPOs, right? And then the IPO market started having a really hard time given the market conditions. Or I know people that had all their money in real estate, but maybe they were a tad too greedy and they used variable rates for their mortgages. You want to have at least 3 to 4 legs to stand on. I think it's totally fine having concentration in one thing for 50, 60, 70% if that is your niche, your focus, right? I mean, I do the same thing myself, where I keep a lot of money in crypto, I keep a lot of money in metaverse, but it still makes sense to have at least some portion of your wealth in other categories, so that when all hell breaks loose on you, you at least have some peace of mind knowing you will never get wiped out to zero. The second note of consideration actually is the opposite, where I say you shouldn't over diversify, especially in a time like this. I think one of the ways people have lost money in the past year, for example, in crypto, is that they did too many things. I was able to evade every single landmine except for FTX, where I was at some point invested in Terra Luna, but I was able to get out before it collapsed. I was at some point a user of BlockFi and Celsius, I was able to get out before it collapsed, and so on. How come? Well, because there's a saying, don't put all your eggs in one basket unless you're the one holding and staring at the basket all day long. Right? Now the thing is, if you are over diversified and you've got 100 assets, some of them could literally burn to the ground and you wouldn't be aware. You might keep money in a bank that is literally going insolvent, it's on news, but maybe you're not watching news that day, and it's gone. So you're actually better off consolidating your portfolio to a certain amount of assets that you actually have a realistic chance of keeping an eye on. Or alternatively, focus on having a manager, right, that keeps an eye on it for you 24/7. Number 5, interest rate risk. And when it comes to interest rate risk, you probably hear, Jerome Powell has been moving up the federal funds rate almost every single month for the last year. It's been the fastest interest rate hike in about 35 years. And we're now sitting at about 5% interest rate at the Federal Reserve level. And the way this impacts you is if you have debts. It could be your mortgage, if it's variable. It could be your credit card debts. It could be line of credits, and so forth. And what I want you to think about is if you do budgeting and you might say, look, I make $10,000 a month, I spend $7,000 and I got some debts, unfortunately, maybe it's a mortgage, maybe it's credit cards and so forth, and I'm paying $1,000 a month in interest. Right? The context is important because maybe you, back in the day, you had a variable line of credit, and that line of credit, like a business line of credit, maybe charged you 3 or 4%. But then interest rates went up, and maybe all of a sudden now it's not 3 or 4%, maybe now it's 8 or 9%. So your interest rate essentially doubled, which means all of a sudden your monthly spending on that has also gone up tremendously. And if we don't know when that hiking cycle ends, it could get worse and worse and worse. And so the way to hedge against that, right, is to think about, okay, how much variability is there in how much exposure, right, I have to interest payments? Like, how much debt do I have? How can I pay that down? And am I concerned based on prognostics? So for example, like the Fed says, look, we're only trying to go to 5.1%, so there's a good chance the hiking cycle might come to an end. But again, the risk is there. The main thing for you to think about is, like, is there a point in time, is there a certain interest rate where things would get existential? That's what you want to hedge for. That's what you want to prevent. Number 6, inflation risk. Look, everybody right now is just optimizing for the market going down, but we also still have incredibly high inflation, where you're currently losing over 6% a year by just holding cash, right? And so you might be the guy that so far said, you know what, I've got the solution. If I put all my money in cash, there's no market risk. If I keep it under my bed, there's no counterparty risk, right? And if I just hold cash, there's also no leverage, right? All the problems solved. Well, you still have inflation. So that is something you do need to protect yourself against. What you can do for that is there's a couple different vehicles. Number one, the federal government actually offers 2 vehicles that protect against inflation. One is I-bonds, where essentially every 6 months they take the average inflation rate and they pretty much offer it as an interest rate on top with a fixed yield. So for example, right now they pay about 0.4% as a fixed rate, and then they slap on top kind of the interest rate that is equal to inflation. And so you're always matching and outperforming inflation. Then there's also TIPS, which stands for Treasury Inflation Protected Securities, which is another vehicle offered by the federal government that again is inflation adjusted, where it makes sure that your principal stays protected. So essentially your principal stays inflation protected. Meanwhile, you have a little bit less of an interest rate compared to normal treasuries. And then third, of course, as a crypto guy, I can't cover this point without mentioning crypto. Ultimately, stores of value may do very well in times of high inflation and the distrust in the banking sector. So whether we're looking at, Bitcoin, Ethereum, gold, and so forth, that too can be a great vehicle, as all these assets are supply limited. And as the government prints more and more money, you will maintain your purchasing power more than likely with these kind of store of value assets. And finally, number 7, liquidity risk. Now, liquidity in itself is not going to lose you money, but liquidity will lose you money when a lack of liquidity forces you to make bad decisions. Because we've all been there, or we've all know people that probably have been there, where you have money on paper and something comes up, but it's all invested, it's illiquid, It could either be fully liquid, like it's an venture deal, for example, where you can't access it, or it's invested, you could sell it, but you'd have to sell it for a loss, for example, at a time when you just don't want to sell. So one really core principle in this kind of uncertain time is to have good liquidity management, right? I want you to think about, how do you structure liquidity? Like, if I need money for the next 3 months, where would I park that? For the next 3 to 6 months, where do I park it? For 6 to 12 months, where do I park it? So that no matter what your demands are, you have different pockets to pull it from without adversely affecting the performance of your portfolio. All right, so in summation, there is a lot more to look at when you look at risk management than just, is the market going up or going down tomorrow? If there's one core principle I see with like the ultra wealthy, family offices and so forth, it's that they really focus on not losing money. And not losing money goes so far beyond just what the market does. If you want to learn more, if you want to get a little bit more behind the scenes with me, I recently started a new email where once a week I want to send out my thoughts, my insights in a more detailed fashion in writing. And so if you're interested in that, check out the description where we'll have a link to sign up. It's completely free, just sharing my inputs and my thoughts. With that, I hope you enjoyed today's session, and I'll see you next time. Take care.